Hello, Warriors. How's everyone doing today? So we never have audio until the webinar starts, Sanjay. Want to welcome our viewers from investing.com. Hello, Sinatra. How are you? Okay, so crude has a heartbeat. I'm showing you the weekly chart right here. We're higher on the week. If you notice, the week before, the range was contained within the previous week's range, which was this huge decline here. I was looking for lower than here, but we did make a new low. We could end up by the end of the week if we take out last week's high, which is up around 25 bucks. Looks like, that would be a lot to accomplish in 48 hours, but it's possible. Also, the 2 week off number comes in at 340. That's a lot doable. And, when you look at all the different time frames, we did make this marginal new low here. It did not confirm. So you've had a couple of divergences. Here was your confirmed low on this drive, and this was your first divergence, but, a pretty low reading. And here we have it here. It's your second higher low on the RSI. Oh, nice to meet you, Ishmael. Okay, so also you look at the 4 hour. Similar, even, better structure here. All right. So this was the low here. Nice divergence. I thought there was a shot for another low when I was looking at it yesterday, but we've had some developments here. And what was really piling on to the market crash that we had was the oil price war between Russia and the Saudis. And yesterday there was a news conference with the Defense Department, and it's being talked or presented as a narco type of thing, talking about Maduro and that his regime is propped up by narco trafficking. So for a drug raid, I don't think you send battleships and destroyers into that part of the world. So when you think about it, um, Venezuela, although they're a basket case, they still have the largest, I believe, correct me if I'm wrong, the largest oil reserves on the planet. So, one way to fix this would be not to let them sell their oil. I don't know if we're going into Venezuela, but with naval ships there could be a blockade on their oil. That could get us a $5 rally in crude, don't you think? So just keep that in mind. I'm not saying that we're going to rally back to $50, but why not a rally back to 30? I think it's pretty possible
Keep in
and
mind, Dale, that Venezuela's production
is low.
has dropped significantly. I mean,
Yeah.
they do have like huge reserves, but what matters having to do with price of oil is how much they actually produce, not how much is in the ground.
Well, we'll see. Whether or not they produce as much as they used to, a blockade of their oil in a
Yeah, it will
position
play
like
a
this.
role.
Well,
Yeah,
that's
it
what I'm
will.
saying. Yeah, that's what I'm
But
saying.
I mean, they're not the marginal producer. That's what I'm trying to explain. So it's not going to be the same like having a problem with Saudi Arabia or
Yeah. Well,
other.
it's an easier target
Of
than
course,
than Iran.
of
So,
course.
we always try and do things the easiest way. There's so much overhang. Venezuela's irrelevant. Okay. Well, call me a contrarian. I think it's going to have some impact, especially in an oversold market. So, and anyway, even if Venezuela wasn't involved, I'm just giving some fundamental backdrop. Go ahead and short it right here. And I wish you a lot of luck.
No, I agree with
Uh,
you. I
all
mean,
right, all
short
right.
is not the place to be.
Well, I'm talking to, everyone, and you know what? It makes me think that I'm right because when you get resistance to something like that, if too many people agree with me about what I'm thinking in the markets, then I get nervous and think I'm probably wrong. I have too much agreement. So, anyway, I think this also could help the case for S&Ps. All right. So, earlier in the week, and I can go either way. I'm a Gemini. I could be bullish, bearish. You guys hear me talk about both sides of the market. Okay, Ben's got a target of 27. When you look at the S&Ps here, and from earlier in the week, I thought that we could get a sell-off, maybe even for a retest. And as long as we're holding 2,400, if you just keep an open mind, even with all the, what's going on with the pandemic, this move from here was about 470 handles. So if this is just corrective action here and we hold this low from yesterday, 470 is going to take you to 2910 or so, and that's 61.8 back. And of course, you're not going to know until we get some type of breakout above here. But to me, it looks like there's potential for this corrective rally to continue. So a weak corrective rally in crude, S&Ps are in better technical shape from breaking out of a wedge. I mean, sure, you look at the news and who wants to be long anything, but it's our job to prep you and open your mind to things that um, the majority would not even consider, correct? So you could go anywhere. You could just turn on CNBC and listen to what the general, what everyone's saying, what the consensus is. We're not consensus traders. We're individual traders that can express our views without worrying about offending one of our partners that may have an opposite view. In fact, we respect it and want to hear different views from each other. And that's why we developed what we have. Okay, so what we have are, yeah, it's got to break 38.2. That would be that, you know, 2600 level. And that's why we've developed this business. It's based upon different opinions, different techniques, different methodologies by some of the best in their own discipline. So, I recommend you subscribe here. I'm going to have one of our panelists post where you could at least try it for 10 days for $1 and see what it's like. And then, once in a while, we're going to have a lot of agreement. But as you can see from the traffic light page, everyone could have a different opinion, and it shows by the different colors that we have here. Okay, Elliott Wave, this is a buy, and here we're kind of, this is neutral. Candlesticks are a buy on Canada. So really, we designed this type of research so that there wasn't agreement, because it's great to have different points of view. You know what doesn't show up in your account? Okay, well, you don't want to follow anyone, FX trader. You want to follow yourself. So what we do, and I would use it, how I use it is intelligence gathering. So I have my own views, like I just presented, right? And then if I want to go and see what everyone else is thinking, maybe I didn't see something. And I just want to say that what people don't realize is it's just as important, and maybe even more important, to avoid bad trades as it is to be in good trades. The reason we don't notice it is because you didn't take the trade, so it doesn't show up in your P&L. But really, avoiding bad trades is very, very important. And do you know how many times I've had an idea, and I respect everyone here who provides their views, how much money they've saved me by not doing what I had originally intended to do by looking at what they see, because I only have two eyes. Okay. And here you have some of the best. Gregor Horvat won award after award on FX Street, which is, I guess the premier FX site on the net as far as views and everything. I used to host a show there and interviewed Greg. I interviewed Blake. Everyone knows Blake's rep. And people are starting to learn about Amanda in our chat room, who's an excellent trader. And we could be on opposite sides of the market. In fact, to me, that's an advantage instead of singing the company tune. So give it a shot for $1, and if you don't like it, I'll refund your dollar to you. But I'll mail it, postage due. Okay, so I think that's about all I want to talk about market-wise. Just one more thing before I turn it over to Blake. Um, Dollar grinding higher, but I still think that we're going to have one more wave to the downside because even though the euro's down today, it keeps trying to grind, and the dollar seems like it's been so strong, but look at the way it's given it back. Now, I don't like to buy days, fade the dollar when euro's weaker than cable. So I'll be looking for a day where cable's weaker than euro to fade the dollar, and we're not there yet. So I think that's what I wanted to cover. Silver's acting great compared to gold. So something else we talked about, the gold silver ratio should still be under pressure. Yeah, it's getting hit pretty good. So when we were talking about it here a few weeks ago, you could have, for your 1 ounce of gold, gotten 128 pieces of silver, and now you can only get 111. So this is definitely possibly rolling over back to this acceleration at 104. I think when you look back in history, you're going to be glad if you um, exchanged 1 ounce of gold for 100 ounces of silver before it's all over. Okay. All right. Thank you very much, Sean. And Blake, how you doing, buddy?
Hey, good morning.
Everyone healthy?
Thus far, yes, yes.
Okay,
So
cool.
we're gonna hang our hat on that. Yeah, everybody's doing all right. Um, so I want to say, and we were just kind of chatting in the chat room a little bit earlier about and Chi made a good comment, and Stelios had something to say, and I want to actually talk about it. um, the S&P, you were just discussing the S&P, and we were just talking about how and Chi had mentioned that I think that the limit down days are over for now, and I agree. Actually, I don't think that you're going to see a lot of days like yesterday. The Russell 2000 was limit down, and even though it was down like 7% by the end of the day, the rest of the market kind of held in there, only down like 3% or whatever. Excuse me. So I think the markets are going to be very choppy through here, through these levels. I don't, I'm not expecting like I'm actually, what I would be thinking at this point
Let's look.
is, well, yeah, this, I was looking for this, possibly inverted head and shoulder pattern, and it may still be relevant as long
Yeah,
as
it
we
took
hold.
one detour. We're still symmetrical there, aren't we, Blake?
Yeah, pretty symmetrical, but I'm thinking actually it's going to end up being more like this for a
Okay.
while.
All right.
So, we might shape up for a near term reversal, but I think realistically it's going to be like this. Now, and the reason why I'm not so optimistic about stocks is because let's face it, the news that we have is not good, and the death rates continue to rise, especially here in New York. And I think that the numbers, and not just New York, I say the United States, I should probably be more more broad with those numbers. New York might actually improve a little bit, but I think there's a lot of areas like Florida is just going to get just pummeled in the next couple of weeks. And even where I live, where some of these states are very lax with their um, uh, less than strict, um, um, more lackadaisical type of measures that some of these states are taking, my state included. So I think that things are going to continue to not be so great over the next couple of weeks. Now, there's a because of this, and um, I think that the stock market, there isn't any reason for us to rally. The only outlier would be there is a vaccine, it's being tested, and it, like, we go, oh wow, hey, a big medical breakthrough. Barring any of that, I have a hard time believing that the stock market's going to get much of a rally. And the longer that we stay at these levels, the more nervous people are going to become. CNBC I talked about this yesterday. They ran a really interesting article how a lot of investors, you think baby boomers, my parents' age that are in their 70s, and no one's selling anything. They're just writing this all out. The majority of investors, they're like, yeah, well, I've been writing this market for 20 years. It's we're still doing great. No one's touching their stuff. But as the stock market stays pretty heavy, what's going to happen is you're going to get the baby boomers that are like, I need I need to start raising money. I can't risk anymore. My pension, whatever. I need to start liquidating some things. And the lower we stay, the more that risk starts to increase. So the reason why I'm bringing this up is because I actually think that the stock market will see another lower level before we start finding some sort of bottom. And if you guys were listening in yesterday during the daily roundup webinar, which is exclusive to our Forex Analytics members, although we do post the video after the fact, I talked about the lower levels that I think are going to be tested, whether it's 2100 or 1800 or whatever, sometime in the future. But I think near term we are just going to be flopping around quite a bit, and it's going to be probably more or less frustrating. Now, when you talk about currencies, the currency market, we have a lot of things setting up, but nothing definitive, especially when you're talking about the dollar. So here's like the euro, and I still think that we have we've got this pennant, and the euro is frustratingly heavy right now. It's trading relatively heavy, but we have to break above 109.70 now, or this trend line here. You can just stay roughly 110 before the euro starts to perk up again. Now the risk is that with stocks, if they stay heavy, that the dollar might continue to stay in demand. So one of the currencies that I really want to focus on is the Aussie dollar. The Aussie dollar has been bid up pretty well, and but the risk is with the Aussie is that we start breaking through some of the support, and this comes in around 80 or 60-50, 60-40 really, but we're getting close. And if we start breaking through those levels, you got to start looking at a possible risk off type of scenario. And some of the other things that are happening, I don't know if you guys have been paying attention, but if you look at the dollar mex, dollar Mexican peso is really strong here, but look at the US dollar, South African rand. We are at all-time highs, uncharted territory, and the emerging market currencies are just getting demolished. Look at the Turkish lira, just a continuation, just moving higher. And I think with these emerging market currencies just getting pummeled, you gotta imagine some of these growth currencies like the Canadian dollar, is going to stay pretty weak. The Aussie, that's had a nice bounce, might roll over and come back below 60 cents. And that I think is a near-term risk for some of these currencies, like and the Kiwi. You can throw that one. That was the Kiwi. Sorry, here's the Aussie. There's the Aussie. There's the Kiwi. Both coming out of wedges. Even though I covered a majority of my Aussie shorts yesterday, I still think that the risk at this point is lower. But I think you gotta be real careful with some of these currencies. I think that they could continue to stay relatively weak. Let's take a look at the dollar index. So here's the dollar index. The dollar index, it has been, in my opinion, extremely hard to read, because the first, here, let me grab a fib here so you can see the false breakdown in the dollar index. The false breakdown below here was, that was an easy, like, oh, look, false breakdown, let's take it on the long side. Then you get this move, extreme move higher. And then the false break out from the upside, the downside was, okay, we got a flush. Now here we are bouncing again. And it's like, I really don't know. I don't know what to do with the dollar, and I don't know what's driving the dollar. And like I tweeted yesterday, at some point, I forget what time of the day I tweeted it. I said, hey, the dollar is just, it's a very hard read right now because you don't know what's driving it. And even the guys in my office on the East Coast, we were talking about it yesterday and the day before. It's like, we don't even know, do we buy the dollar because stocks are going down, there's a lack of dollar demand, or is it the Fed that's pumping so much money into the system that we have to be dollar bears and look for places to be dollar sellers? And I think the market is kind of at a, you can argue either point. So because you can argue either point, there's no definitive trend here with the dollar, and it's tough to read. That's why I think focusing on some other cross rates might be the better trade as of now, at this stage in the game, rather than trying to focus on the directionality of the dollar. Let's look at what might what some cross rates might be to play, right? And like if you're looking at the Aussie and you're like, well, the Aussie, I know where the breakdown point is. You got to keep an eye on the Euro Aussie. I think the Euro Aussie is one of those currency pairs that had such an amazing move higher that I don't think that we're done with upside. I don't think that this was a reversal, because if you look at longer term, these are not this is not uncharted territory. This is a massive break higher. We are now consolidating these gains, and I think the risk is that we start making another move higher. Now I'm really going to be more excited about the Euro Aussie when we're above 181, 182. That would be more exciting to me because I know that we're now carving out higher highs. But I think that if you guys are thinking in the vein of, all right, this market's going to stay heavy, then the currencies like the Euro Aussie should stay relatively well bid. And I think that these are places that we have to keep an eye on in this current environment, for currencies like this that could really start taking off again. Like I said, as long as the S&P is fluttering around the, let's call it 2,300 to 2,600 range, and we happen to be near the upper end of that range right now, then yeah, if we trade back below 2,400 back to 2,300, then that means the Euro Aussie is probably going to be trading up towards 183, 184 again. So like I said, I'm more excited about the crosses than I am the dollar at this stage in the game. And I think you can play the dollar. You just have to be very careful and take any profits that you have quickly. And if you have if you have a loss, just get out of it quickly. Just realize that you're wrong and get out of it, because I don't think the dollar has a very clear direction as of right now. Okay. But that's my 2 cents about the FX market. I guess one of the other things I wanted to bring up, and I'm a little irritated with myself, is that I am not long gold at the moment, and I really wanted to be long gold. And you can see it was building a nice base, and now here we are. Gold is breaking out. So any dip now down towards sub 1,600, I think down here probably would be an opportunity to be on the long side. Somewhere below 1,600, get some people that might have chased it to the upside. They get stopped out down here and then be long and look for like this base that's been building. So as Dale pointed out earlier, silver's looking a little bit better, and I don't know if silver is going to outperform gold. I'm not going to try to make that prediction, but I do think that these pairs are building decent bases and look, look pretty good. Look like they're about ready to start moving again. So anyway, I wanted to bring up my my colleagues, Steve and Stelios. How you gentlemen doing today?
Good morning. I'm good.
Good morning.
Good
Hey,
morning.
Day 28 of lockdown, but who's counting, right?
Yeah, day 28. How great is that, huh?
It's good. The whole family together, it's fine.
Yeah,
That's what we keep telling ourselves.
I know. I told my kids that yesterday. I'm like, I'm because they were like, well, Dad, your life hasn't really changed a whole lot. I'm like, nah, mother, other than the fact that I'm not driving you guys all over the place in the evenings, my life.
So in essence, it has changed for the best.
Yeah, but I told them, like, I'm happy that you guys are home, and I know where you're at, and I know that you're safe, and that's the most important thing. And for everybody, stay home, stay safe, and I know it's trying times, and but yeah, I mean, that's it. So anyway, so this market's really, in my opinion, a little directionless at these levels. So what are you guys thinking here?
Well, personally,
I don't think it's going to be for much longer.
Yeah, we were discussing this in chat room. I think there is one more leg lower. Has to be, because we've said this, I think, yesterday. The average retail long hasn't sold yet, hasn't capitulated. So I think there's going to be a capitulation. Speaking of the dollar that you mentioned just a while ago, I think we will see another big flush lower in equities. I've said it before. I think 1,800 to 2,000 the S&P, and that will probably drive the dollar lower, higher, just like it did in the previous sell-off. During a sell-off, people want dollars. That's the rule usually. So I think the dollar is going to spike. Metals might get sold a little bit. Commodities, currencies might get sold a little bit, but then that will all reverse eventually. So that's my view. When is this going to happen? I have no clue. I don't know.
Yeah. All right. Well, I appreciate your thoughts. Steve, how you doing?
I'm good, mate. Everybody's okay. Exactly as you said, my life hasn't really changed that much. I just have to drive Jason around less. So, it is what it is.
Yeah.
We have to go through it.
Right. Yeah. All right. Well, hey, I'm going to pass it over to you guys. For those of you that that haven't visited our webinar sponsor, Forest Park FX, they really are, some of the best in the industry. It's for finding you a broker. And if you're not happy with the brokerage firm that you're using currently, or if you want to be part of the Forex analytics community, make sure you reach out to them, because they can put you in the reimbursement program, and you can get to them through our website. You can just click on where it says reimbursement program. Their email and Skype is right there, so you can talk to them directly and just see if they might have a better solution for you with the brokerage firm that you're currently using. I know a lot of people were upset, this last month with, some of the brokers that they were using based on, how they were being treated, or, some of the pricing during the very fast moving markets. So reach out to them. They're the ones that are in touch with everybody. And so I just wanted to give them a shout out, since they are our sponsor.
And Blake, we had this conversation, the two of you, last night. In one of my accounts, in one of my two accounts, I just happened to check that during the past 1.5 years, I've paid more than $20,000 in commissions and rollover costs, etc. And since I actually joined this program, I actually get some of that money back. So it's quite nice.
That is nice.
Yeah,
that's nice. Well, that's why you need to, if you're not in that boat, you need to be reaching out to Forest Park FX and talking to them about that. All right, guys. Well, it's all yours. Thanks everybody for joining in. Have a great interview, Dale. I'll catch you guys. I'll catch you guys tomorrow, and I'll see some of you on the daily roundup later.
Thanks, Blake.
Thanks, guys.
Thank you, Blake.
Bye, mate.
Bye.
So we have initial jobless claims, which has become the most important number of the week. So let's wait
Here
for that.
Here it is. Tell you in 20 seconds.
Yeah, 3.5 million roughly.
Previous expectations, if you remember, were very low. It was for 1 million, but now expectations have really climbed higher to 3.5 million. I remind that the previous reading was at 3.3 almost. We also have
Yeah.
trade balance, which is expected to improve. Makes sense.
Let's
Totally
see.
makes. Oh my
6
God!
point, oh Jesus,
6.6,
this is
6.7 million. Yeah, that's
oh my God.
roughly 12 times the high that we had during 2008.
Yeah.
Just to put that in context. Okay, it's double. It's almost double. It's actually
Oh,
exactly
look,
double last
it's
week.
very interesting. Very interesting. The euro dollar isn't doing anything. The market just doesn't know what to do with this number.
Yeah.
Right. Euro dollar hasn't moved like 3 pips. Interesting.
Yeah, it's the market is like frozen. It really doesn't know what to do with this data.
Yeah, not even metals. You know, metals usually really move on data like this, and okay, they're up
Yeah,
already.
just put
But
that in context, Elio. It's
The
12
markets,
times.
the market's not saying anything because it's afraid of being laid off and being included in the numbers.
Yeah, that's a good point.
It's
just put that in context. This is 12 times the worst number we had during 2008.
Wow.
I mean, it
just shows that we've been saying it all along. This is a very different kind of crisis. It's not like 2008, and anybody who's looking at it the same way, I think it's not right. So, you know, it hasn't been. I don't remember. Obviously, I wasn't born. I wasn't born in the Second World War, but I don't think there's any point in time since then that the whole nation just was unable to work or to go out.
Yeah.
So it's just
been 100 years.
Yeah, and
territory.
People would do well to realize that, you know, there isn't anybody that's. I mean, there isn't almost anybody that's not going to be hurt by this, right? I mean, everybody's going to suffer one way or another, and you know, there will be repercussions.
Yeah,
there will be repercussions.
Because you know why, guys? You can't just be long spiders and think you're a genius anymore.
That is very true, actually. Which, to be honest, if we didn't have all this manipulation and moral hazard being thrown into the market during the past 20 years, that should never be the case. I mean, the markets were never meant to be a place that somebody can close their eyes, belong a broad basket of things, and do well for eternity. Because, you know, the markets are there to perform a specific function. And that specific function is properly allocate money based on risk reward. So when you have a whole system trying to suck out the risk from the system, which of course is inevitably something that's going to fail. I mean, you can do it for a period of time, but the only thing you do is you make things a lot worse when you are unable to stop, mispricing risk. So that's what has been doing, and now they're attempting to do it even more than in the past. Do you think it's by accident that, let's name it quantitative easing 4, which isn't 4 because we've had in between, we had the repo, quantitative easing, etc. Do you think it's by accident already after less than a month bigger than all the previous quantitative easings combined? No, it isn't. The reason is because there are diminishing returns. For every time they attempt to, in quotes, fix the problem by using the same remedy, more and more is needed. Exactly, and if you remember, I've given this example multiple times, exactly as it happens with drugs and drug addicts. The more you take, the more you need just to feel okay. And at some point, you need to take so much to just feel okay that the overdose is going to kill you. And I'm afraid, as I've said since, you know, it was obvious at some point that, you know, this crisis is, you know, is not something temporary, because, you know, even if we assume the best, and we do hope for the best. I mean, let's hope that scientists, you know, can find a cure for coronavirus in 0 time, and, you know, everything go as fast as possible back to normal. You know, the damage has already been done to, you know, the global economy, to the financial system, etc. So I'm more afraid now that we know that inevitably the damage has been done, of, you know, what kind of a damage the therapy is going to do, than the virus itself. But we'll have to see and go through it. Stelio,
Taking
what else
a
did we-
shot at the short side of gold here, Steve. It's about halfway back to 61.8 back of the decline to, I don't know, this week's low. You know, so if we're
I
gonna get
still
it
don't
one more
see.
one,
I still don't see something clear here, Dale. To be honest.
yeah,
And as I've told you, in the case of gold, silver, and then anything that is a tangible commodity, that's why I also agreed with you having to do with I wouldn't be short crude no matter what. You know that. I mean, I've been saying since crude was trading at 30 that I hope to see a flash down to teens because I think that the risk reward being long from there is going to be asymmetrical, right?
Yeah.
Exactly as we were talking about the VIX at
Well,
20th of February.
if it fails from here, gold equality would take it down to about 1540, 15.
Yeah, but you know something, you'd better err in the side of being long in gold than
Yeah,
in
I gotta stop him, bro.
yeah, of course,
sense.
of course.
Makes
That
sense.
makes sense. I mean,
Anyway,
yeah.
all right. It's just a, you know, everything's just another trade to me, buddy.
Of
I
course.
used to
And
have
it's-
emotional attachments to my biases, and I was a lousy trader then. So, you know, I just, you know, see what happened and what it's doing now. And just, you know, even though there's an emotional bias about gold, it did drop $80 and it's rallied back 40 or so. And, you know, just taking a shot and
Yeah.
letting
Yeah,
our
I mean-
audience know. That's all.
I mean, you can definitely take a shot, and I definitely even see the case, the technical case for a move down to 1390, as we've
Okay.
indicated here.
Yeah.
Can happen, absolutely.
I'll take
absolutely,
80
it can.
bucks from, I'll take 1540 on this
Yeah,
trade. if it
absolutely. I
happens.
mean, you know, for short-term trade, the
Anyway,
risk
we're
reward
getting a
makes
little
sense.
bit of a wick on it right now, so you could even like tighten up stops over today's highs if you did it. That's
Yeah.
all. I just wanted to share it with the crowd.
Here is
Yeah, good.
the
Call
four-
me
here's-
P.T. Barnum.
Here's the 4-hour
Everybody,
chart.
come on in and check out the show and get short gold for $80. Just like
Here
P.T.
is
Barnum.
here is the 4-hour chart. My only worry with that as a short-term trade would be
Yeah,
the fact that this pullback so far,
yeah, it's corrective.
yeah, looks correct to me. And
Yeah.
you know, we're retesting now this. Actually, as you see, it's a
Yeah.
confluence of resistances. So yeah, from a risk reward perspective, as long as this area is
Right.
holding, looking for something like this definitely makes
Yeah.
sense.
Yeah.
But I would start getting really worried if we
Oh,
went
yeah.
above that and they were short. Just
Yeah, I have
letting
like
you
a
know.
$20 stop. You know, in this environment now, you used to be able to trade gold with $5, $10 stops. You almost have to magnify your
Yeah,
stops
impossible to do it
by
in this
you know,
market.
like double it. You know, so if you were used
No,
to
I'm totally with you.
risking 50
totally with you.
pips in euro, you
I'm
got
totally with
risk
you.
100 pips now and just reduce your leverage.
That's one of the reasons I've stopped since years ago using stop losses. But as I've said, I don't advocate that people should do that. I can do it because I don't use leverage. So, you know, I'd rather have mental stops and, you know, go based on that, knowing that even under the worst possible scenario, as it happened to me once with oil, if you remember,
Yeah.
you know, I can definitely survive that, right?
Yeah.
So yeah,
you
I'm
know,
with you.
you have to be very disciplined to use mental stops, okay? Because you know, if you're not, it'll get to your mental stop, and you go, you know what? I'm going to give it a little more time, because I didn't have that kind of discipline. That's why I have to go with hard stops. Because the last time I used a mental stop, my first stop was a mental institution.
Yeah, I
All
remember
right.
you saying
Anyway,
that
you
before.
could do it, but I can't.
Speaking of which, you know what helps amazingly with discipline, and that's why we've talked about it again and again, and we ended up deciding that we actually want to, you know, do that. We want to produce, you know, such a product. A trading journal does. It does a lot, because once you write down the logic that is behind each of the trades, first of all, you do three things. First of all, you filter out the urge of emotionally jumping on something, because if you need to put some notes down of why you enter a trade, you force yourself to rethink it as you're writing it down. And sometimes you might find yourself not being persuaded by your own thesis. So you might end up not going into the trade. Now, once you go into the trade, and you've committed in writing down, what is your logic, why you think your risk should be at a specific area, why you think your limit order should be at another specific area whatsoever. What happens is that once, for example, you hit the area that you shouldn't be there anymore, it's not easy to talk yourself out of it, because you've already gone through the process of explaining to yourself why that's all you wanted to risk.
Here's an excerpt from my trading journal. So I shorting crude because of moving averages and confluence, and then she walked into the room and she took off her jacket and approached me and put her arms around me. Oh, that's the wrong journal. Sorry. Everyone should keep. That was my diary. Sorry. Okay.
I'll tell you what my wife tells me. You'll be a teenager, for the rest of your life. Right?
The question is in what respect? Oh, anyway, okay. Right. What did I want to say? Yeah, I want to mention oil has been.
Ziggy says, then she rubbed crude oil all over me.
Nice. So in case, I don't actually remember if Blake mentioned it, oil has been going up today, mostly because China announced that they're buying oil for their strategic reserve.
For the reserves, yes.
Yeah.
Yes.
And it kind of makes sense. We've been talking about this, that there are automatic stabilizers with all these things. So oil at $20, who thinks it's going to still be here in 2-3 years time? No way.
I don't.
So yeah, I don't either. So they're doing what I think is prudent, and they're stocking up.
They are, and
my
that proves once again, Stelio,
yeah.
that China is playing. Unfortunately, I'm really, I'm really sorry to have to say that, because I definitely don't like such a, example of government. Unfortunately, not having the problems of political cycle, China can afford to play the long game. That's the truth.
Yes, absolutely. So yeah, so that's what's been pushing oil a little bit. Obviously, it's going to remain volatile for the next days, weeks, but I think we're going to see production drop off eventually, and the surplus that exists at the moment. Last night's build was the biggest we've seen in months, I think. That's going to all, eventually get taken out, and then limited production is probably going to balance things, and I think we're going to creep higher from there.
To begin with, Stelio, we've definitely seen clearly on the chart, this is a 4-hour chart of crude. We can definitely see here, to begin with, the downside momentum, waning. It has actually completely stalled. So I'm not saying that it's impossible to see another flush lower, but I hope we do, because I would so much love to be able to buy crude at 17, at 15.5 that you see here. I mean, I would love to. But we might just outright blow through this descending wedge and never look back. And in my opinion, we're just one headline away from something like that happening. One. I mean, one day, for example, especially if you're in the US, because the US session has the disadvantage that many of the active hours for the rest of the planet, the US is sleeping literally. So especially if I was a resident of the US, I would be very afraid, if I was short crude, that I might wake up one day and have left crude at $20 and wake up one day and find crude at $28. And it might not sound that much, right? But a move from 20 to 28, which I do believe it can happen, right, is going to be like a 40% move higher. And what's going to happen to your account if you're short and while you're sleeping, there is some kind of a huge headline like, OPEC with Russia or whatever.
Yeah, exactly.
Yeah.
Exactly. And the headline is going to come eventually.
Yeah, it will.
it's going to come. So, you have to be careful. Obviously, the counter argument to that is that if you want to go long oil, you have contango everywhere in every instrument you want to trade pretty much. So you have to time it, or you can be long producers. Like I have been doing long Shell. I've said this in the chat room a couple of weeks now, and I got
that's
out
very
today.
true.
I got out today.
Some of
It's up
them even
10%.
still pay a dividend. I mean, you don't only have contango.
Yes.
But you actually have the opposite. I mean, you have some kind of an income.
Yeah, I noticed,
By the way,
Stel, that Total, even when crude was down, TOT, I don't know what country that's from. Where's Total? Is that
Total Fina Elf? It's French.
Oh, okay.
French, yes.
All right. And it was up big yesterday with crude hardly doing anything. It's recovered like from the low 20s to the low 40s with the market doing this. So anyway, a friend of mine.
But by the way, our friend is asking when Rohit is going to be on. He's going to be on in about 15 minutes. Okay.
Yes. In 15
He's
minutes
great
time.
too.
At the top of the
very
hour.
good technician. It's a holiday in India. So whoever is asking about Rohit, what's a holiday in India today? Modi Day, cashless. They're going to take away more cash, dirty cash, because the virus can be spread on notes. Oh, okay. I don't know what the holiday is in India. Do you guys know?
No idea.
I don't.
Really no idea.
Oh, Ram Novi.
Ram Novi.
I don't know.
Okay.
No idea what it is, but I'll take your word for it. Hindu festival. Okay.
Okay.
Interesting. You see, it's nice having participants from all over the planet.
Yeah,
enjoy.
It is. It's great. Oh, it's
enjoy.
religious. Okay.
Okay. So let's go through some of the questions because we have plenty of them. Good thing is that the vast majority of things haven't really moved since we were here yesterday, so I can as well jump on questions immediately. S&P got a break 38.2, right, Mr. Blake? I'll tell you, there are two scenarios here in the S&P if you ask me. One scenario is we got rejected from the 38.2 because so far this is the case. We have been rejected from here. One scenario, we go directly lower from here. Okay. Second scenario, in my opinion, is we find support, I would assume, not far away from here, 2400 or something like that.
Better hold that.
Push higher once again. I wouldn't be surprised if the next move higher, if that's the case, would be towards the 50% fib here at 2790, and then go for another move lower. So these are the two scenarios in my mind. So within the next couple of days, maximum 3-4 trading days, we're going to know which of these two scenarios is going to play out. But in any case, in my opinion, in all likelihood, we're going to be moving lower, either following scenario A or scenario B. I know, and I'm putting it here because I have huge faith in his abilities. I know that Gregor still has a count that implies that we might have already seen the low here. Although he has a secondary count that also looks for one lower low before we actually move higher. But my main case scenario remains that we're going to be moving lower. But as I said, it might happen after another leg higher that we might see. As we said, we're looking for a move anywhere between 1800 and 2000, where we might actually find some like big support and produce some type of a long-term low. At least in nominal price, is as good like said the day before yesterday as well. Let me see. Hi Blake, what's causing those spikes, and can they happen again anytime soon? Colin, what instrument was Blake talking about when you asked about the spikes? Tell me so I can actually answer that. Is there a risk that the equities go lower than the megaphone formation on S&P? And two, what would make it go lower? Housing rates? What do you mean? The question here, Frederick, is what can make the S&P go higher? I can tell you one thing. The only thing that supports the S&P from not completely getting decimated is central banks. So if we assume that there was no central bank support, the S&P would have already drilled through 1800 and we would be testing 1500. So the question is not what can make the S&P and these indices go lower. The question is what can support them in not going lower, because we currently have an event that's unprecedented in recent history. We have complete shutdown of the vast majority of economic activity. So when calculating valuations, the most usual index we take is PE, right? Price to earnings. At the moment, E, earnings, is a huge unknown with estimations that can be anywhere between extremely bad and horrific, which means that the PE at current levels might prove to be extremely more overvalued than it was at 3,400 based on the expectations about earnings we had 2 months ago. So anybody that believes that, for example, at 2,400 the S&P is undervalued, trust me, it isn't, because earnings can take a hit like no hit you've seen before. Perhaps make 2008 look like a walk in the park. Steve, can you take a look at half? Yeah, sure, we can have a look at it. You said there was central bank intervention, I'm assuming against the US dollar, right? You want to have a look at it. Another chart that has really gone vertical here. I mean, clearly a prolonged uptrend, right? I mean, what can I tell you here? Let's first fib extend the last big corrective move lower. Okay, you see there is some resistance here, right? 161.8. RSI divergent, but only during this last part of the move. So, I mean, there might be more pain here for half, especially given the fact that if you zoom closer, this was clearly a corrective pennant and we just broke above it. So on the other hand, just taking the pennant's target and fib extending it, that would have an implied target at 362 and change. So, still definitely no evidence here for a reversal lower. So, until we see some big reversal in the dollar against all the exotic currencies, it would be, a very dangerous proposition to be short. I think you'd rather wait for a big daily reversal first and then start looking for downside targets. So until further notice, high probability that there is going to be more upside. The same thing applies to anything like Blake showed USD-ZAR. Look at USD-ZAR here, right? Vertical. Look at USD Turkish Lira. I mean, it has some divergences that I need to pinpoint out here. Dale would call this, how do you call it, Dale?
What, divergence? It doesn't
Three
look like
drive.
a three drive using the. I see two. On the RSI, you have you're diverging, but on the price chart right now, this would be drive 2. See that 1, 2, maybe get a pullback and then a 3.
Maybe another attack then of this trend line resistance.
But you know what? When you have that much divergence, it may not be necessarily a short, but it's a warning sign to be pairing longs. Okay, so it doesn't mean you reverse, but it's saying, well, you know what? Prices aren't confirming anymore. Why don't I go to the table, go to the register? That's the way I would use it in this
USD Ruble also not so distant from the all-time highs, and for the time being, this formation looks like a pennant to me, and
Yeah.
the implications of that would be a breakout higher and further upside. Needless to say, guys, that this move higher in the dollar is really hurting a lot of the emerging markets.
And you know what? Looking at your run through right here, Steve, it looks like they have like one more hurrah. And then even some of these emerging market currencies look like they could recover. Maybe that's when the dollar really turns, is when the weak sisters.
And keep in mind that it's going to be the time, and I said that multiple times, there's going to be the time, and in my opinion, it's not that far away, that it's going to be amazing being long all those exotic currencies, because not only you're going to be making money from being in the position and the exchange rate.
Well, you get paid to own it.
You get paid very well to own those positions.
Okay.
Very well.
That's a thing that a lot of people do not think about when they're trading, Steve. Why don't there's some people that aren't as, don't have as many years under the belt. Why don't you give them a quick explanation that on certain pairs, especially if you're a position trader, it's going to cost you to finance it, and on others you get paid to finance it.
Yeah, actually, that's the case, and that is something you do have to take into account, because as I told you from my example,
most don't. I didn't for a long time.
Yeah, I've paid during the last 1.5 years. I've paid more than $20,000 in one of my accounts, because I happened to check it yesterday, just for rollover costs, commissions, and dividends. Dividend you pay when you are short an index. Just for people that don't know, so you have to pay the dividend in essence for being short an index. So
that's a big factor in your performance.
Absolutely. Are you kidding me? Absolutely.
Meanwhile, gold's coming off. This is what I do. So I take partial profits here, and now I'm going to pull my stop down to above the high of the day. Okay, so just want to let people know you could put $5 in your pocket right now. And okay, go ahead, Steve, because
some people here, probably due to Rohit, are also asking about the USD INR. What I said the other day was that it still looks bullish to me. I said a few days ago that worst case scenario, it revisiting 72 before moving higher, but of course there is a very likely scenario that it's not even going to revisit 72 before it moves higher. Okay, so this looks more like a corrective formation to me. So as we said about the rest of the exotic currencies, it looks very likely to me that before we can see the Indian rupee actually rebounding, so in essence USD INR turning lower, it looks to me like there is more upside before we see a reversal. So that's what I think about it. And an upside target from here would definitely be the 161.8% fib from this corrective move lower, which, as you see, there is at 78.5. I have a couple of more minutes, so let me go through some of the questions.
You know the cue now, right? I'll give you the cue.
Yeah, I know the Kidar, yes.
Yeah, all right.
Can you please share your insights
Steve, before I let you finish, did you tell the copper wire joke to anybody?
No, but it was amazing. I'm going to say that today to some friends.
All right,
yeah, it was amazing.
Okay, yeah. Not here. We can't do it here.
Yeah, no, we can't.
All right.
So here is platinum. For those that are asking, keep in mind platinum. You might see a big recovery, but keep in mind that 775 is a huge area of resistance. So you have to be careful there. Keep in mind that even if we see lower prices in platinum, which there is a chance that we're going to see something like that, I'm really very bullish in the long term. So I need to stress that out, right? Having to do with palladium, still some type of consolidation. Yesterday, when the indices were tanking, we had quite a big down day in palladium. And that's one of the reasons why I'm still short palladium here after this big rebound higher. I'm in the money. And I do believe, that there will be more downside in the indices, that's why I believe there's going to be more downside in palladium. Now, having said that, if we do see indices produce another leg higher before lower, then I would expect that palladium might even hit 2,500 first. That's why I only have 1/3 of a position being short here palladium, because I do recognize that we might see 2,500 before lower. So keep that in mind. And we also had a question about Euro Kiwi, and I'm going to wrap it up with this, so Rohit can take this in. So let's cover both Euro Aussie and Euro Kiwi. Euro Aussie holding this ascending channel. The downside momentum has clearly waned. So if indices continue lower from there, because we know there's an inverse correlation between Euro Aussie, Euro Kiwi, and risk assets, I wouldn't be surprised to see Euro Aussie move higher directly from here. And of course, the same applies to Euro Kiwi. Here is Euro Kiwi. Otherwise, another leg lower in the case of Euro Kiwi, since you asked about that. If that's the case, if we see another leg lower, watch for 178.50 to 179 being support, and then higher. Okay. So what about Nifty? Okay, Nifty. I'm assuming
probably cover it.
I'm assuming he's going to cover it, but
Yeah, he will.
you know,
Go ahead.
my very fast outlook on it is that, you know, impulsive move lower, corrective move higher. Worst case scenario, what we're going to have with Nifty is one move higher, one little corrective move here, one more leg higher towards 9,400 to 9,700 and lower from there. Okay, that's what I think about the Nifty. Okay, thank you, Coach.
All right, buddy. Hey, Rohit.
Enjoy the interview.
Thank you very much, everyone. I'm going to get Rohit set up now.
For our friend Ali that is asking, what about gold in the long term? In my opinion, and Stelios has said the same, we've said the same, with current monetary policy being hugely inflationary and definitely driving currencies, fiat currencies in losing real value, since you're asking for the long term, right? I mean, nobody can guarantee you what's going to happen in between, but in the long term, in my opinion, there's only one way metals can go, and that's higher.
Thank you, Steve. Rohit, welcome back to Face.
Thank you, Dale, for having me back in a long while.
You were great last time. You know, I'm so glad you got back in touch with me. I remember your work. I, you know, was impressed. And I want to thank you for stepping in and, you know, coming off the bench at an important time in market history to share your views. You're definitely a headliner, but I also appreciate that you came in to help us out today in Face, Rohit. So I'm just going to let you take it away. What are we looking at? And it looks like something completed. Is that the Nifty?
That's right, Dale. So it's my pleasure to present this. And I think the last time we were discussing, we were in late stages of completing this ending diagonal on Nifty, which is what I was showing. And I also discussed the Nifty 500 chart. So I'll come to that as well. Okay. But I wanted to start off with the Nifty chart. This is, of course, a quarterly chart of the Nifty index, where I've marked 5-wave advance. Now, this is one of the alternates because it's a pretty long-driven move. There's one other way of really counting this, which I'm taking as my preferred count. But this is how I had started marking it in 2010-11, where I thought that this entire structure here was a triangle formation, and that you were to do a last fifth wave. And so at each point, we've been thinking where exactly that fifth wave will end, and then it really extended quite a bit. And what we couldn't really do here is we couldn't put this inside a channel, which is what you typically expect in an impulsive move. For example, that's what we ended up seeing here. This was very well channeled in the third wave. Even this wave was very well channeled when it occurred. And so this is just something I thought up just right now. Otherwise, if I try marking this 5, it's not very good. So what I ended up doing eventually, and what my preferred count at the moment is something.
Let me just stop you there for a minute. The way you have that last structure labeled, if you go back to the chart before that you had up there. Okay, so to me, I'm old school. That's a rising wedge in your ending diagonal to me, and you have the line anchored where 4 is. Yes. That's the bottom of your wedge line. So based upon, you know, old Edwards and McGee stuff, you'd expect 100% retrace of the wedge. So is that your target where wave 4 is on this move?
That's correct. That's what that's what Elliott wave analysis projects, that you go back to the fourth wave of previous degree in the upcoming bear market eventually. So that's definitely a final level where you get.
Isn't that interesting that even old school rules like wedges and, you know, reversal formations and Elliott wave, I love when different methodologies point towards the same outcome. It gives me even more conviction about it. So
completely,
because, you know, if I start talking Elliott, I'm dangerous. Okay. But if I stick, if I stick to what I learned, you know, 30, 40 years ago, and then someone who's a competent Elliottician has the same type of targets, objectives, actually gives me more conviction about what I'm seeing. So
yes,
thanks.
so I completely like that approach. In fact, I use classical technical indicators as well, sentiment readings as well when I'm doing this, including everything like advanced decline ratios and so on. So it's great to see things all come together, and they do at important
And look at that
points.
volume you have at the bottom of your chart. It just completely exploded on the breakdown.
It completely did now. So if I go just one level down, since you mentioned volume, I'll just switch it back to a weekly chart, where you can actually see that explosion started right here in the late stages of this wedging. And you notice that even this last part of the wedge itself looks like an ending diagonal. So this is what made it really interesting, that you know, the E, and this I found this initially I found it in a lot of currency charts, and now I'm increasingly seeing it in equities, that wave E of an ending diagonal itself converts into a triangle or an ending pattern before it breaks down. And so it ends up taking far more time than we really anticipate, because it does that. And what we noted here is there was a huge sell-off here. And at this point of time in India, the mid-cap indices, like the BSE mid-cap or the NSE mid-cap 100, all peaked at this point, after which they've fallen around 40% from there. The Nifty itself, which is the mainline front index that everybody watches, did not really crash that much in this sell-off, which is why this volume here is really reflecting the broad market selling off ahead of the index itself.
Where does that wave 4 come in price-wise on the Nifty for a downside target, price-wise?
I didn't get you.
4.
Yeah, so that's at around 5,100.
Thank you, buddy. Go ahead.
Yeah, so this explosion in volumes now has, of course, happened with the Nifty index itself breaking the wedge line, both in the short term wedge, the long-term wedge. And in fact, as I'll move towards the Sensex. So, but before I do that, I was just going to another way of looking at it. And this is the type of chart I think I probably discussed in my last phase interview, is that I was looking at this entire structure developing as an ending all the way back from 2009. And the reason to do that is that from this point onwards, I have not been comfortable with the counts of the internal counts of these rallies, because I'm counting them on a daily basis. And I found most of the moves to look like they are correctives in series of threes rather than series of fives. And so I thought, so I had only two options. One was the earlier one, where the series of threes is part of a triangle at this stage itself, or else the entire structure is an ending diagonal all the way from 2009 lows to date. And that would then make it a much bigger structure. Because what I'm thinking also is that this ending diagonal, why it's such a big ending pattern, is that we're actually ending super cycle degree bull market in India, which is, I think it would be a 50, 60 year. In fact, it dates back to, I think, the 1930s. There's only one chartist who's actually created that data, and which is Vivek Patel. And his back data would show the extended third wave in India lasted from the 1950s post-independence all the way to 1982. And then you had, then this phase is actually more like a fourth wave on a very long-term chart. And then the fifth wave is really completing now. So I think we're completing something which is at a much larger degree, which is why I've been calling it an economic winter. And when I call it an economic, so in India, most people have not really started to accept the idea that we are in a winter. And it amuses me because I started writing about it when this triangle itself was forming. And after that, within 6 months of that, most companies that were high on debt have actually gone down since 2010 itself. In 2015, we first time started to recognize non-performing assets. And by the time we were in 2018-19, all the mid caps and small caps peaked out. And so despite we are facing those problems and our NBFC or non-banking financial sector being hit with serious problems in 2018 itself, we have still not come to recognize that this is a major cycle degree problem. So that's the interesting part here. Everybody continues to be bullish and still thinks it's a buy on dips.
How long does winter last, Rohit? Time-wise?
So I have found that it varies from market to market. The most closest comparison people end up making is 1929, which in a stock market terms lasted only for a couple of years. But in economic terms, it may last for even a longer period of time. So how I've
10
come
years,
to,
yeah.
10 years. So how I've come to tune with that is sometimes the market may do it earlier, because in the market, Elliott wave wise, we are looking for A, B, and C. And once we complete an ABC correction, the market may have done its job. The economic weakness may sometimes continue till wave 2 of the next cycle degree bull market, which is why I think in Proctor's book, in the psychology of waves, he says wave 2 occurs on either as bad or worse economic data. So the news is sometimes even worse at wave 2, even though you're making a higher bottom, and which is why it's so difficult for people to latch onto it.
Yeah, that's a very important point, because, when we finally get to a point to where we have some, even a rally to new highs in S&Ps, if you look at a broadening top, I know there are some Elliotticians that say after 2100 S&Ps, that in the next few years, we could trade 4,000 S&Ps, by 2025. It's a different view than most likely what you have. But a lot of people are going to think that everything's okay, get the all clear just because the market stops going down. But the Main Street pain can last a lot longer, even though you begin, equities begin to appreciate. And I rarely hear people talk about that. That's a very important point for people to understand. Thank you.
Yes, there's definitely a big lead lag between price and actual news and sentiment. And probably those divergences is what, as analysts, we try to identify. So the chart I'm moving on to here this is the Sensex. And the reason I'm using the Sensex, which is a 30 stock index versus the Nifty, which is a 50 stock index, is it has more history. It was incorporated in 1978 when we only had the Bombay Stock Exchange as the individual exchange in India, and they launched this index. And having this history actually allows us to get more context of what has happened all the way since 1978. So what has happened in this quarter, which is what I'm pointing to here, is we've broken the quarterly trend line, which comes all the way from 1980,
Wow.
touched the 2001 low, and we've actually closed a small amount below this line. So this is a very, very major break. Even the fifth wave, as we see, is actually much slower than the previous waves. We've had pretty powerful moves in all the other waves, but this was a much slower advance, probably the slowest I've seen in the Indian market, which completely fits the idea that the ending diagonal is occurring not just on weaker economic data, but also on slower momentum than the previous wave formations, and has eventually broken the lows. And of course, you can see the same in volumes. Volumes completely dipped during this phase and now are exploding as we start to break down. So this is where we structurally are. What people are trying to figure out, of course, in the short term is whether we've hit a bottom, at least for the next bounce to start. And for that, I have two alternate scenarios. The first one is this, which is that I do feel that the fall from this top, which is at around 12,246, probably completed a 5-wave decline at the recent low of 7,511. And if I go by that conclusion, I could be looking at two potential outcomes. One is, of course, a regular flat in wave B. And the second is an expanded flat. So I've put both possibilities open, that if it's a regular flat, then probably Nifty does not break around 7,100 or say 7,500. That was the low that it made down here.
Get a higher low for C. The
so
other
it makes
one
a higher low than 7,511, right?
Okay.
And then heads higher. The second case is, of course, it does 123% of A or 138% of A, which is typically seen in expanded flats, which would then allow it to retest around the 6,900 to 6,800 low. Now, somehow I do feel this may be a higher probable outcome. And the reason is that there are many charts of either individual stocks or even global indices which look like they have a fifth wave down pending, which could actually push the Nifty much lower as well. And this would also bring us very close to the previous swing low. So I'm zooming out here. The previous swing low is where the last rally started. That's here at around 6,825. So this entire last advance, which started on the monthly or quarterly charts, started from this point, and it's possible we retest that and make some kind of a bottom closer to that level. So I think this level becomes an important point where you can complete something.
Okay, nice look.
Now, the alternate way in which some people would want to count, I'm not completely comfortable, but it does fit what is happening around the world. That is, you have a wave 1, 2, this is 3, and we're currently bouncing in 4, which may be over or may continue to form as an ABC. And then you still have a fifth wave down pending before we can say wave A is complete. The only problem I have with that, at least on the Nifty itself, is that what we mark here as wave 1 on the daily chart definitely does not look like a 5-wave decline, because if this is wave 1, it should be 1, 2, 3, 4, 5. It so far looks like ABC, not just in terms of the count, but also in terms of channeling. You don't have a 5-wave fit. You actually just have 3 waves into a channel and then it bounces back. So not a very good idea to mark this as 1, which is why what I've done is I've taken this high as the orthodox top or the truncated top for the previous run up.
Like a fifth wave failure?
A fifth wave failure.
Okay.
But in a sense, I wouldn't say fifth, because what I discussed earlier is we're taking this entire structure as an ending. So it's basically wave E. This is wave E, but I'm saying wave Z of E, probably the last corrective structure, ends at this high. So I would probably say Z of E.
Okay.
Of the fifth, ends here, and then it's not 2. And this is what my preferred outlook is. But this is an ongoing discussion among analysts that, take it as 2, then this is only a 4th. But in either case, I do think there's room for one more decline here, whether it's a B of B or whether it's a fifth wave, which fits with, like I said, if we simply go to maybe global indices, like if I move to the S&P, the trend line from the highs is what we just tested. And it does look like possibly a 3rd, 4th, and a 5th could be still developing. So if that's the case, which shows up in some, there are only few indices, like I looked at the Australian market, that of course looks like it may have completed a 5-wave decline, but there are many others that probably have not. And so if there's a 5th down, I think there's that one more leg lower before we get a final low point, where you'll probably see divergences maybe in volatility or in volume or in momentum itself, which would then give us a clue that the 5th is ending. Now, once we have that 5-wave decline, and that's the next part of the discussion, how much are we going to bounce back? And after such a big fall, most people don't usually anticipate that, you can go up much. But I've seen, at least in the Indian market, or even if I look at the Dow way back in, say, 1929, the B wave, the first bounce back after wave A, ended up retracing almost 50 to 60% in most cases. So, which is a pretty large counter trend swing once you complete this move down. So it's interesting to wait and watch where that happens, because then you can actually get something worth playing into. So if I do a 50% retracement, you can easily come close to the 10,000 Nifty again once the sell-off is complete. In fact, even if I go back to, say, the 2008 bear market in India, which started a little later than the US, the first bounce back that we got, so that's the example I'm just taking, this one retraced a little more than 50% after we did wave A down. So wave B did that, and then we again sold off to test lower levels. So you often see that kind of a pullback. I think even in the case of the Dow, people like to look at the example of this is 1929. You had this first wave A, and you've done a little more than 50% retracement in wave B. again here, people would want to know what time does it take, and I've found different time scales. Sometimes wave B can be very fast, and in some cases, as in this one, it ended up taking several months, and whereas wave A itself was just 2 months long. So I'm not able to put time onto the element how long it would take for a wave B to complete as and when it starts. What I would look for is a 50% or more retracement once we are able to mark a completed fifth wave for wave A on the way down.
Okay, let me ask you this. I don't know if you're prepared for it, but your countrymen really like precious metals. I was wondering if you had any view on the gold and the silver.
Yes, so I will go to that, and I'll look at both gold in the Indian currency terms and
Okay.
also look at gold in dollar terms, and they can give completely
Different pictures.
Different pictures. Yes.
Yeah.
So I'll just have the charts.
Thanks for your flexibility.
So sure. So this is, of course, I'm looking at the gold chart, which I've backdated up to say 1968. I've not gone before that. And we completed, of course, one bull market we all know of in 1980, and then it was A, B, C down, and we've started another bull market. You can see from this low in 1999. So the way I'm marking it is that this bull market was probably the first wave of a new trend that started on the way up, and the pullback that we've seen from 2011 is a second wave. Since 2015, I've been considering that we've mostly bottomed out. I'm not expecting new lows in the gold price, especially since we formed an ending diagonal here at this bottom.
Okay.
So the way initially I marked the decline in gold was to consider it as a complex pattern, which is WX. I thought probably Y is done here, but increasingly I'm thinking that I'll probably move Z to this point simply because some of the moves within this range itself are also corrective in nature. It's not very clear that this is wave 1 and 2. What is very clear is this entire rally that we've seen from the bottom in 2018 is a very clear 5-wave advance. So I'm inclined to think that what we've completed here is probably the first wave of a longer term bull market, and we are probably pulling back in wave 2 as far as the dollar price is concerned. So we probably see a further pullback. We may not have completed this pullback. It may be we've just completed wave A. We are bouncing back in wave B, which is
That's what I was thinking.
78% retracement, I think, of
it was.
And we should probably do wave C down. So this is what I would expect. And then once that is complete, I'll probably look for a third wave on the way up. So this is my near-term outlook on at least the dollar price. Now we have a very different picture when we look at the INR price. Just a moment. Okay, now in the near term, the INR price shows a slightly different picture because of the impact of the USD INR itself. So probably I should also look at the USD INR after this.
Okay.
The USD INR has been in a longer term upward trend, and many times in the past, even when I think the dollar price has been in a bear market, say in the 1980s or 90s, because the INR was weakening, the gold prices in India have continued to move higher. So this is when you really look at it long term. So I'm going to, I think I had a chart of the MCX price without all my indicators.
And you're getting a couple of requests for the Bank Nifty. Maybe you could wrap it after you're through with this on the metals.
Sure.
Okay.
Sure. So this is the gold price in INR terms all the way from 1977. Okay, the picture that it shows you. So like I said, between even the 1980s when gold was going down in probably dollar terms, you've seen it go up in rupee terms simply because of a weaker rupee. So the rupee has been weakening for a prolonged period of time, and that's where gold has provided a strong hedge. So in that sense, gold prices in INR terms have made an all-time high this year, and the rally does not look complete. Just unlike what it appears in probably dollar terms, it looks like we have a series of 1 2 1 2 1 2 going on, and now you're just beginning to subdivide in a series of 3, 4, 3, 4, 3, 4. So I think there's still upside in rupee terms. Probably the downside will continue to get limited by weakness in the currency itself. And eventually, I'm probably looking at it going to at least the top end of this channel, the immediate channels, which would put us closer to. This is, of course, a kg chart. So this goes almost to 87,000, which is in, So this is 43,000 right now. And we're looking at it going to maybe 88,000 over a period of maybe a year or two or a couple of years.
Okay. There are some people like Jim Sinclair that thinks that gold will be in US dollar terms, 50,000 one day. So we see it in INR terms, and it's already there. Maybe it's foreshadowing what could happen when the dollar finally ends its bull market.
So with
Do you
that,
have a view on the dollar?
yes. So I'll quickly go to shall I go to the rupee dollar?
Sure, yeah.
So I'm looking at the rupee dollar chart. Now this is starting, now see, this is a big history of long weakness in the USD INR. So I would say this is one entire bull market, whether a market has a third wave or a first wave. And then we had a decent, very clear A, B was a triangle, C pullback when India was actually going through a bull market in equities, which is between 2002 and 2007. Now during the 2008 bear market, I think the USD INR started a fresh move up. So I've marked that as 1, 2. It's working itself out in a very, very nice channel. We had the third wave complete in 2013. And then you had this long consolidation, which I've marked as a fourth. So we are now in the fifth wave of this move. And the fifth wave itself, I believe, has started to subdivide because it's not gone all the way straight to the top. The central bank has been intervening and keeping the volatility from really taking off. But the larger trend continues to be strong. So I sense we are now in the third of the fifth. And that itself is now subdivided. So we got the first, within that third, we got a second. And we are right now in what I would say is wave 3 of 5. So we might get a fourth wave pullback at some point of time. Maybe a 38% retracement or a pullback to the daily averages would be fair. A 38% retracement would mean somewhere around 74.20 or so from the current range. And then probably you will head higher in the fifth of this move and eventually cross 80 or go to around 84, 85 is my sense for this particular rally that is ongoing. But when I really look at a long-term chart, there are longer-term channels. And if I simply take just this channel, the top end stretches all the way closer to around 100. So
Wow.
I think eventually that's where we'll probably be heading by the time the fifth wave completes.
Nice look.
So when you ask about the dollar, I think earlier in your earlier part of the interview, you was speaking to your guests, and there's some confusion with the dollar index because it's broken both sides of its 1-year trading range.
Yeah.
And so what I ended up doing is I ended up looking at the emerging market currency index, the MSCI emerging market currency index. I hope you can see this. Can you see this on?
Yeah.
Okay.
Got it.
So this chart gives me more clarity because when I zoom out of it, the emerging market currency index went through its first sell-off in 2018. So this sell-off was probably the first wave, which I believe is a 5-wave decline. So it's either 1 or A. And then you had this long channelized A, B, C pullback. And now you've started a third wave down, whether it's 3 or C, and it looks incomplete. So far, within that structure, I think we've done the initial first and second wave. We are within the third 1, 2, 3, 4. So we have still got a lot of room down, I think, for this move to complete. And what this tells me is whether the dollar index immediately moves higher or not, the emerging market currency pairs continue to be under pressure. Probably they'll continue to stimulate by weakening their currencies. All of them are doing it. India just did it last Friday by cutting rates almost 75 basis points.
Okay.
And so I think this is a trend that's likely to probably continue and will be a pressure point for many of these markets.
Yeah, great look. I really appreciate you being here. Do you have a website, Rohit?
Yes, my
right.
website where I regularly write is indiacharts.com.
Why don't you show it so people know how to follow you besides your, your Twitter handle is at India Charts. And if you'd like to show your website, you go ahead and do that now.
So indiacharts.com, very simple name, and moment they come there, they can always see the latest post on top. And then the series of previous posts. Most of these posts here, which you see, the latest ones are free.
We're still seeing a chart. So you probably have to stop sharing and then, unless you, to bring up your website, because we're still looking at the global currency index.
Is it visible now?
Yes, now we have it.
Okay, so this is the site. Moment they come onto it, they can see the latest posts that I've made. And there are a series of links to all the free posts that are the latest. So the latest one always shows up on top. Now they can either join the free mailing list by putting in their details out here, or they can subscribe. So what I do is I write every day on all of these markets, my daily update on the wave count on everything from global commodities, currencies, indices and stocks. I cover the entire list on the Elliott wave count and the momentum setups. And I send out 2 emails every day, or else the posts keep going online on the website throughout the day. So people can either subscribe to that, or if they just want the free posts, they can just join the free newsletter and read them online. So those are the 2 ways they can interact with me.
My trading warrior brother, Rohit Srivastava, thank you so much for edifying our community, the FACE community today, and providing us with some great looks and lots of food for thought.
Thank you, Dale. Thank you so much for having me.
I hope that pips rain down on you and your loved ones remain untouched by this virus.
Definitely.
So
definitely.
really appreciate.
We hope this will be a short-term phenomena that we all deal with and it passes by, I guess.
Do you have thoughts on how long it's, we're hoping short-term. I bet you really have thoughts on the ramifications and what's going to happen here. You want to share that with us?
I think it has a significant bearing, at least on social mood, which is what we study from an Elliott wave perspective, because people are not going to travel, eat out. A lot of things are going to change in behavior. So it definitely is having that impact and having an impact on the world economy and various issues related to debt that have come to the surface, which you're going to deal for months to come. So that's one part of it. Of course, there's no clue as to how long the virus impact remains. I think everybody's discussed the corollaries with the Spanish flu, and it's amazing so far that in India, at least, we have the number of case counts are still low. Some of it may have to do with more kids coming in for testing, but we are not seeing so much community spreading of the virus. So we've asked, the Prime Minister has asked everyone just to sit at home, and that's probably working. So we enter the last 2. Everyone's hoping that this 3 weeks of lockdown, and which is purely left to the citizens. So citizens have been told that you take care of yourself, sit at home, and that's the best way to sort this out. And people are doing it religiously out here. So we are hoping that once 3 weeks are done, the case counts are not out of whack, and we are able to sail through this smoothly.
And it's just part of this winter season that we've entered, isn't it?
But it's much warmer in India. So India is really hot. It's like almost 30 degrees to 32 degrees centigrade.
I'm actually talking about the financial winter that you were talking about. This too, this too is part of the winter. So anyway, Rohit, thank you so much for being here, and I'm going to get you scheduled for June. Later on today, let's touch base, and thanks again. Good trading to you, and thank you everyone for hanging out with us today. We'll wrap up the week with the NFP tomorrow. So remember, no matter what you're trading, if you're short, if you're long, if it's gold, if it's silver, if it's oil, don't just count your pips, count your blessings. See everyone tomorrow. Thanks again, Rohit.
Thank you.
Adios, everyone.